On this hot sheet, I discuss housing inventory mortgage rate predictions from 8 leading research firms and mortgage delinquency rates. Today is Monday, August 14th, 2023. I am Byron Lazine, and your hot sheet starts now. Welcome back to the hot sheet. Hit the thumbs up. Please consider sharing this episode. It's the best way to grow the show. If you could hit the thumbs up, leave a comment, and share the episode, that'd be greatly appreciated. If you're new to the channel, make sure you subscribe. We do this every single day that the markets are open. We're the only live daily housing show on the internet. Others dream of doing it. We just actually do it here at BAM. And as we do every single Monday, we jump into inventory. And I want to jump right into it here. According to Altos Research, we're hoping for an increase. We did get one. Was it enough? The weekly inventory change for the week of, and the screen's not working there, so let me just go and fix that. Hopefully this will do it. All right. There we go. Just got to love this switcher, Bobby, with Apple's iPads. It was actually on as well. There we go. All right, weekly inventory change from August 4th to August 11th. Inventory rose from 487,000, basically 488,000 to 492,000. Okay, so we did get a slight increase, not as much as we would want. Got about 4,000 or 5,000 active listings added to the market. Last year, this time, we had a little bit more, 6,000 or 7,000 to the active listings. And last year we were at 550,000 active listings the same week. So 492,000 compared to 550,000. We're at our peak for inventory here in 2023. In 2015, the peak was over 1.2 million. We're under 500,000. So considerable difference on inventory levels as it relates to now in a more normalized market. Here's your inventory look for the last 3 years. We're year over year negative, continue to be pretty much on a flat line, now starting to get similar to, how we performed in 2022, starting to flatten out after that sharp increase. 2021, we were still on the upward trend. So hoping for a later upward trend this year. New listings is what's holding us back. We're on track to have the lowest level ever recorded of new listings coming onto the market. For this week, we had 60,759. Same week last year, over 73,000. Same week in 2021, over 79,000. Here's another way to look at it using Realtor.com stat. This chart was put together by Lance Lambert over at Fortune. Month-over-month shift in U.S. homes for sale on Realtor.com. This does show an increase in active listings month over month, 32.9 thousand for the month of July. So the highlighted bars are July, but last July, you can see we had 118,000 increase in active listings. So 32.9 would be the lowest since 2019 going into 2020. The second lowest on this list for a month of July going all the way back, or third lowest, 2017 would be the next lowest there. And so that's just another way to look at it. All of these charts are available down below by signing into BAMX. If you are a member at BAMX, sign into your BAMX account, and we do a daily download of all the charts here that are available for the hot sheet. If you're not a member of BAMX, use the code HOT to get 10% off of your subscription into that. All right. Let's take a look now at where we're at on interest rates. There was interestingly enough on interest rates, a projection that was covered in Fortune, and it's a housing market outlook where to expect mortgage rates in 2024. This is 8 leading research firms and where they have these mortgage interest rate outlooks. We've covered many of them. Many of them tell us that going into 2024, they'll be lower than they are right now. We could today, we're gonna get into the 10-year and how much it's up just this morning and why it's up. We could today hit our highest mark of 2023 on the 30-year fixed mortgage. On Friday, we came out at 7.19. Our high mark is 7.22, according to Mortgage News Daily's survey. But let's take a look at where some of these groups expect us to be going into 2024. Okay. Mortgage Banker Association, they project that the 30-year fixed mortgage rate will average 5.9% in quarter four rather of this year. So they're expecting us to come off of these 7.25% rates and get down to 5.9% average throughout quarter four. Okay, that's interesting. That's Mortgage Banker Association. Okay, so Mortgage Banker Association has us going into 24 under 6. Morningstar projects that the 30-year mortgage fixed rate will average 6.25 overall for this year and 5.0% in 2024. So Morningstar has us getting to get to 6.25 average in 2023. We got to get closer to or at 6% for the majority of quarter four. So Morningstar in line with Mortgage Banker Association, big drop coming according to them. Goldman Sachs, the investment bank, projects that the 30-year fixed mortgage rate will end 2023 at 6.4%. So Goldman Sachs has us coming down almost, 3/4 of a point between where we sit today and the end of 2024. Okay, that's where they expect us to end. They expect the 30-year rate will average 5.9 in 2024. National Association of Realtors, economists at NAR forecast the 30-year fixed mortgage rate will slide to 6.4% before the end of the year. That's in line with Goldman Sachs, of course, and then 6% average in 2024. Morgan Stanley, the agency MBS strategists at Morgan Stanley project the 30-year fixed will start 2024 at 6.0%. So Morgan Stanley believes we're going to get down to 6 by the end of this year. Moody's Analytics projects the 30-year fixed rate will average 6.5 through the majority of this year. Means we got to come down a little bit at the end of the year. They tell Fortune that they expect, this is Mark Zandi, to slide to 6% by the end of 2024. So Moody's is looking for a quarter four drop to get close to an average of 6.5% on the year. Realtor.com believes that will start 2024 at 6.1%. So over a full percent drop from where we are today. Fannie Mae forecasts that we will average 6.6 throughout quarter four in 2023. So Fannie Mae, the most bearish, and in my opinion, the most realistic, the most bearish on the 30-year fixed mortgage rate for quarter four 2023, having us over 6.5 at 6.6%. They expect rates to grind down to an average of 5.9% by quarter four 2024. So not by the end of this year. They're seeing 5.9 coming by the end of next year. And we're more likely to be sitting above 6.5% in quarter four of 2023, according to Fannie Mae. They expect an average of 6.1 throughout 2024. Okay, so those are your 8 forecasts. Still 7 of the 8 have a really, and this is a current forecast. They can change these. They likely will if they get a lot of information that their information's trending wrong or inaccurate. But out of all 8, only Fannie Mae believes we're going to end the year over 6.5%. Back in June, Bill McBride wrote a piece on Calculated Risk newsletter. Could 6 to 7% 30-year mortgage rates be the new normal? Been talking a lot about this. I believe we're in a higher for longer situation. Most of that has to do with where we're sitting on the 10-year yield. Right now, today, the 10-year is up over 4.2. 4.2 it's a big number. It's the biggest number we've seen in the last 5 days. Here's the 10-year, the last 5-day outlook. Here's 1 month just trending straight up. And why is the 10-year continuing to go up right now? What's causing this increase on the 10-year Treasury? Well, Logan Motoshami over at Housing Wire has some thoughts in this week's market tracker update. Let's go back to his 2023 forecast. His 2023 forecast's range on the 10-year yield has been between 3.21 to 4.25, emphasizing that bond yields can go lower than 3.21 only if the labor market breaks. The labor market breaking to him is if jobless claims on a 4-week moving average go over 323,000. Currently, that data is 231,000. The economy has stayed firm. Bond yields are at a higher level of his range for 2023. One of the reasons for that, if you look here at the top, and I'll read it, a valid case for higher mortgage rates in the short term is that we are simply going to be in an environment where we don't have a lot of bond buyers versus the supply coming in, thus making it harder for mortgage rates to go lower. We saw an example of that last week. Okay, don't have a lot of bond buyers. So that's pushing the 10-year yield up, all these treasury yields up, because there's not a lot of bond buyers. Now, as we go and print some more of this money that we just approved, it's coming later on in the year, we're going to have to sell more bonds. Okay. We just raised the debt once again in this country, which means we're going to have to go and sell more of these bonds. So there is a camp out there that believes that there'll be even less bond buyers in the future. Now, they may come out and say, well, I want these new bonds, that the yield is getting so high that maybe it brings more to the market, but they're already holding a lot of U.S. debt. It's incredibly high. So this could create a situation where, again, even higher than we maybe anticipate for longer, if we continue to see a shortage in bond buyers. Essentially what happened, last week and coming into this week is people were trying to sell bonds, investors trying to sell bonds, and they couldn't, and it pushed these yields up even higher. Not that they couldn't, but they couldn't get it at the rate that they wanted to. Okay, so this is pushing up rates considerably, and we could be in a situation again. I've been saying it since last week, where we're just higher for longer. I think that's likely to be the case. It seems really hard to believe that we're going to have some significant drop by the end of this year. If we have a job crisis before the end of this year, does anybody see that coming? I certainly don't right now. The numbers aren't saying that to be true. I did mention last week that there's some earning reports from some of these job hiring companies that are cutting back. Maybe that is a precursor for some type of job crisis. But we're at 3.5% unemployment rate right now. Job market's very strong. There's still a job surplus, out there theoretically. Maybe it's not the right jobs, but there certainly is still 9 million jobs available according to the numbers. So, GDP continues to grow. The economy continues to be quite strong while we are experiencing a cooling of inflation. We've got back-to-back months of our lowest inflation reports since 2021. So we'll continue to watch this, but I would anticipate a higher for longer environment. And you haven't seen, home prices come down despite the stickiness in the interest rates, which just means for a buyer, if you're waiting for this crash, it doesn't appear to be coming. And even if there was to be a crash, it'd be a long time before you start to get those short sales or foreclosures coming your way. But I wouldn't count on any of them. Why? Because mortgage delinquencies decreased in the second quarter of 2023. And that delinquency rate is the lowest since 1979. In other words, the lowest delinquency rate ever. Why? Because that's when they started tracking the data. The seasonally adjusted mortgage delinquency rate fell to its lowest level since Mortgage Banker Association survey began in 1979, reaching 3.37% in the second quarter of 2023, said Marina Walsh, CMB, MBA's Vice President of Industry Analysis. It's a resilient job market. Homeowners are continuing to make their mortgage payments. The only thing that really, again, impact, like Logan was saying, and now Mortgage Banker Association is saying, the only thing that can really impact, a situation where we get lower rates, it's going to happen first with a cratering in the job market, which is then going to impact people paying their debts, which is then going to impact the Fed's decision to cut and cut quickly, which is then going to reduce the rates. But that'll be, the fourth step in that really elementary process that I just broke down. Despite low delinquency rates, there are early signs of possible consumer stress. This is talking from Walsh. Delinquencies are rising for other forms of credit, such as credit cards and car loans. In addition, FHA delinquencies rose 10 basis points compared to level years ago. On a non-seasonally adjusted basis, FHA delinquencies rose 13 basis points year over year and 71 basis points from the first quarter of 23. As the economy slows and the labor market cools, homeowners with FHA loans are likely to feel the distress first. Okay. Now, not everybody agrees with that. Logan Motoshami would be one of those, believes that credit and other forms, credit cards and cars, have kind of risen with expectation. But that's one way to look at it. From Mortgage Banker Association. You can see here, this is a great chart. I put it in daily download today for BAMX members. You can use code HOT to get 10% off your BAMX membership. You get daily downloads every single day from Hot Sheet, all of our live streams, all of our courses, private Facebook community, all of that. This one's in here. It's a good one to show to, that Twitter doom and gloomer, or that uncle of a buyer who's saying, wait for the foreclosures, they're coming. Well, we're at the lowest level of mortgage delinquencies ever recorded right now. And so if you're waiting, be comfortable waiting. If we were to have something change in the next 6 months, you're still waiting 2 years to really capitalize on that market. And so if you're willing to roll the dice and wait for that, here's the information. If you believe what I believe, that you're buying below the next peak today, because the last 4 decades show us that home values go up 30 or 40 or 45% in every single decade, and we're below peak prices in many communities from last year. If you believe you're buying below tomorrow's peak theoretically being 2 years out or 5 years out or whenever that next one comes, and you're going to be in the house for 10 years, you're in a can't lose situation. So continue to home shop and lock in the right home for you and your family when that opportunity presents itself. So again, and thank you for the kind words there. Again, we ended the week last week at 7.19 on the 30-year fixed. The Freddie Mac 30-year fixed weekly came in at 6.96. And this 10-year, I'll be watching it closely today, over 4.2. I think we'll hit the highest 30-year fixed read of the year, which is 7.22. Probably be over 7.25. 7.37 was the highest read of 2022. So are we approaching that? Unfortunately, it seems we are. We're 1 week out from the Tom Ferry Summit. If you don't have your ticket yet, you can get $100 off the lowest price, which I think those prices are increasing this week, a couple days, maybe even tomorrow. So get $100 off the current lowest price by using the link below to come join all of BAM at Tom Ferry, or some of BAM anyways, at Tom Ferry Summit. And next week, Tuesday through Thursday, August 22nd through the 24th, we have BAM Bash on Tuesday, the 22nd. BAMX members, you automatically get in to BAM Bash. It'll be the best party of August. Of course, the best party of September is BAM Camp. BAMX members get 25% off of that ticket. That ticket's also going up this week. There's a link below for BAM Camp tickets as well. Hope everybody has a great start to their Monday. Let's hope for that 10-year to not go too high today. Let's be super productive. I'll see you back here tomorrow on the hot sheet. Until then, toodaloo.